trading strategy for you guys and for us, and with the Algo 17, that's our program that we developed on the back end of TradeStation Technologies technology. And basically, there's the old adage a lot of traders have been asking, what's the best way of exiting? Again, there's an old friend of mine who once made a statement and said, what's more important? If you're piloting a plane, takeoff or landing? And the answer depends on if you're already in the air or on the ground, right? So takeoff is kind of important if you're on the ground, but if you're in the air, landing's more important. So what came first, the chicken or the egg? So in this case, what's the most important element? If in day trading, it's a momentum trade, and this is live as of right this second. It's exactly 4:18. It's August 15th. We've had a whale of a run in the market. Once again, the strategy shows us with two contracts, and you can clearly see sell signals or connect the dot. If it's a red line like this long right here at approximately 250, went long at around 68 and a half and got stopped out at 61 and a half. So the moral of the story is that it wasn't a good trade, but it had all these wonderful signals and took shorts this morning, a nice big long trail to stop, got right back in on the action, got stopped out, a trailing stop, got right back in. So the question is, and I'll go through this with you right now so you'll see the parameters. What's best? Running just multiple contracts, getting all in and all out, or getting in all at once and scaling out? And that begs the question. So this is interesting. So let's get into this, because the seminar that we're doing in December, the Algo class and the 2-day live trading seminar, will be using both Thinkorswim. We'll be using other platforms, but also TradeStation, helping people to develop their own strategies and learning how to do it. So what's interesting is that what's the best profitability? And we built this in the Algo Optimizer on TradeStation. So let's take a look at the strategy performance, and we'll walk it down straight from top to bottom. So this is goes back since May 14th. So it's a 3-month system. Now, some would say, oh, that's not long enough. And once again, it is long enough because the sampling of data is over 300 trades. It's done more longs, almost 200 versus short. There's 197 longs and 130 shorts. The shorts aren't as profitable, 41%. The longs percent profitable is less than 50%. And some would argue that's not that good, but the profit factor is that's the select profit factor that's pretty decent. And more importantly, here's the probably the beauty of this system is the drawdown. So the drawdown, max trade drawdown is only like $1,500. So it's not like you're taking huge risks. And the performance over the last 90 days, up 74,000 trading 2 lots on this model. So how would it work to trade and scale out of half a position? Is it best to get in all at once and get out all at once? Or is it better to get in one and let one run? That's the question. Let's find out the answer. So basically, I'm going to do this with you live right now. So we go over to Edit Strategies. And as you can see, here's the Person Algo Extreme. I'm going to go over to Customize. Now, this system trades from 6 in the morning to 4 in the afternoon. So it does not trade the Asian hours whatsoever. Position size, 2 contracts. Let's go down here to Exit Strategy. So it says Scale Out Ratio. I'm going to put half. That's it. I'm making one change. I'm scale out. Now, let's say, for example, I wanted to find out, and I've already done it, but if I want to find out what's profitable using the optimization function, 0 for true, 1 for false, increment of a half. So find out true or false. And I just, since I'm doing 2 lots, it's either get out of all, half, or none. Obviously, those are the 3 choices that we have. And that's what I'm gonna cancel the optimization. And I just wanted to let you know that function is available. And what I'm gonna do is just go straight into where it is scale out ratio and go 0.5. All right, here we go. And now I'm gonna hit OK. So wait. Before we do that, let's double check something, and let's take a look at strategy performance. Performance graph. It had a little rough go at it from June 19th to a bottom. It gave back some profits, obviously. It had a drawdown function from June going into July 19th. Kind of a pain in the neck market. That was the end of the quarter. We had, again, the rollover from the June contract to the September contract, and there's all kinds of crazy things going on. All right, fine, no excuses, but how's the performance? Again, the performance summary, 74,000. That's all we need to know. All right, now let's take a look and go back and take a gander here. Studies, edit strategy, go up to customization, and let's get out of scale out ratio 0.5. Hit OK, close. Now let's see the results. Interesting. We had a short on the with all out. This is a scale out. So this one got out, and since the function didn't get out at the profit, it didn't trail the stop to break even. It traded on the dynamics of the trade. It had a buy, got stopped out, so it missed the big run, got right back in on the horse, good job, got out of half a position and let one trail. And then it's still long a couple positions on this strategy. So when we alter one item, it completely changes the trade. So you're not going to find the same trades. Here's an example. This one got out of the profit target and it trailed the stop at break even. And we actually, behind the code, it's not really break even. It's 2 ticks above the entry. So just to ensure you cover your cost of either the nominal commission and take something off the table, right? In case there's slippage as well. All right, let's look at the performance, and that's the key. Do you get out of both contracts, or do you get out of half the position and trail the stop? That's the question. And to find that out, I mean, I'm sure there's multiple variables, and there's all kinds of, with every answer I give, there's going to be another question, or there's going to be something else. But we got to start with a baseline, and that's all I'm doing here. Just all I did was I didn't change the profit targets. I didn't change the ratios. I didn't change the risk factor. All I said was get out of half at the intended profit target and trail a stop on the balance. And what do you think the performance is? $16,000. What a disaster. So again, there's your performance. Nothing even close to getting out of everything. So maybe we do a little bit more work on this, but I thought it would be a great eye-opener for this YouTube lesson to share with you. If you have the PPS signals and high close and low close doji signals that we've created, and you have a reasonable risk-reward ratio, and by the way, as everyone may not know, so I'm just going to highlight this again, when in a trade and it initiates the trigger, the red line is the initial stop loss, and the blue line is the first intended profit target. So it will get out. If the market doesn't quite hit the profit target, it trails a stop, an emergency stop, and that's what the orange is, right? And then it got out of half the position, and then it's going to get out of the other half at like a tick above break even. And in this case, it didn't. It just kept going. And if you look up here, you see that little yellow dot, and it got out because that was the trailing stop function, that yellow dot. We can go back and look at, again, a lot of other trades, and you'll see here, here's a beautiful setup. So you can clearly see if you get in a trade and you get out with a tight profit and you let the other one run. Sometimes you get out with a profit and you let the other one run. Sometimes, the runners aren't as impressive at times, and maybe it works 1 out of 100 days or 1 out of 20 days. But those other 19 trading days, you're giving up a lot on the table. So therefore, we go back and we go to strategy performance and say, how did it look? The profit factor, first off, on shorts is less than 1, so not so good. What's the risk factor? We jumped up from 1,400 to 1,600. So there's more risk. Even there's more risk scaling out. So sometimes we think that scaling out's a great idea, but until you get back into the nitty gritty and examine, and there's a little bit more what happened with each trade, and there's some other things that we can do. But I think just from a very quick perspective, finding out, do you get out of trades all at once, or do you let them ride? In this case, let's just go backtrack one last time, and we're going to go to studies, edit strategy. What did I do? I changed one function. That's it. Scale out half the position. 0.5 is half. Nope, don't want to do it. I don't want to scale out of anything. Hit OK. Let's go back. And what happened? All right, getting in and getting out all at the same time. $74,425, like magic. Profit factor's a lot better on shorts. Profit factor's 1.7 versus on the long positions, and that says a lot. And then again, the risk, 1575, 1425. That's what it was on the longs. Excuse me. So, how is the overall performance? If you bought the E-mini futures on May 14th, when this strategy was back tested for the last 90 days, you have a buy and hold of 4%. The return on capital on this platform is slightly better at 74%, and a return on account, which is because of margin that was used in the positioning, was 424%. So obviously a lot better than buy and hold. So that's another function, that a metric that we want to measure a trading system. Would it be better? I mean, it's good to make money, but would you make more money by just buying and holding rather than trading in and out? So, I mean, anyway, three months is the time frame we went back. You're in the market 37% of the time, so you don't have a lot of wall of worry. A true day trading program. And again, I think just a little eye opener to say, hey, what's better, scaling out or getting all out? And in this particular case, we did it with crude oil, and it showed scaling out does not, at least with that model, did not show more profit. In a 5-minute, again, this is a 5-minute day trade model on the E-mini S&Ps, and I was asked if I could share that information. When I did the crude oil, we had a commentary, and someone emailed us and said, hey, would you show me a 5-minute E-mini, because I don't trade crude oil. And agreed, and I didn't have a problem doing that. I hope you enjoyed that. If you want more information about the 2-day seminar that we're going to be involved with down here in North Palm Beach, Florida, it's in December. It's my annual 2-day live event. We've done a seminar for probably over 20 years. Fabulous time, sunny South Florida. We call this the Mecca capital, golf capital of the world. By the way, I think we got 30 of the top 40 golfers living within a 4-mile radius of where the seminar will be. Jack Nicklaus, Tiger Woods, the list goes on. With that said, come to the website, personsplanet.com, and you can find all the information you need under seminars at the top header. Thank you all very much, and we'll put another video out there as we go through looking at the different stocks and the overall condition of the market. But I thought in the meantime, we'd follow up with this particular concept and just get it down to what most people can relate to, day trading E-mini S&Ps. Have a great afternoon. I hope you enjoyed the video, and if you did, give me a thumbs up. And you can always put a comment down there in saying, hey, I'd like to see this, or what else you got, person, and it'll all be good.